Okay, let's dive right into this explainer and unravel a macroeconomic mystery that I know so many of us are feeling right now. We're going to look closely at the math and the actual mechanics to understand why earning a six-figure salary today feels less like hitting a massive financial milestone and honestly, a lot more like running on an endless financial treadmill. And look, it's a universally felt frustration. The coveted $100,000 mark used to mean absolute rock-solid financial security. But the data reveals a very different reality today, and we're going to break down exactly where that money is actually going.
So here is the hard mathematical reality we just have to face. When we project out to 2026, a $100,000 salary actually has the purchasing power of just $60,000. Yeah, you heard that right. It is a massive drop. And this is due to persistent compounding inflation in absolute essentials, specifically things like housing and healthcare. So if you're earning six figures and still feeling completely broke at the end of the month, well, this mathematical gap is the structural reason why. The dollar amount on your paycheck hasn't changed, but what it can actually acquire in the real economy, it's completely plummeted.
And it gets even wilder when we look at high-cost states. If you live in places like Massachusetts, New Jersey, or Maryland, earning $100,000 literally qualifies you as lower middle class. In fact, the upper limit for that lower middle class bracket in these states now exceeds $114,000. It completely, and honestly somewhat unbelievably, redefines our traditional understanding of wealth brackets. What used to be solidly upper middle class income is now barely keeping families above the median line in these coastal hubs.
Now, this dynamic brilliantly illustrates the housing squeeze that is just crushing our purchasing power. To simply afford a median-priced home in the U.S. in 2025, buyers are going to need a staggering $126,670 in annual income. What this gap represents in the real world is that 75% of middle-income households are entirely priced out of the modern housing market. It's a massive, massive barrier to the traditional American dream of homeownership.
So how does this system actually profit from all of this? Because when the middle class gets squeezed, that capital doesn't just vanish into thin air. It gets redirected. Let's look at exactly how that wealth transfer happens.
Well, banks profit massively by capturing the spread. They are paying savers less than 5% on their deposits, right? But while they're doing that, they are simultaneously charging 20% or more on credit cards. As stagnant wages and rising costs force everyday people to borrow just to maintain their normal standard of living, institutions capture that massive delta between the tiny 5% they give you and the 20+% they extract from you.
Let's look objectively at the broader mechanics driving this, kind of behind the scenes. On one side, you have corporations actively suppressing wages because their main priority is earnings per share, basically making their stock look good. On the exact same time, the Federal Reserve bought up $1.33 trillion in mortgage-backed securities between 2020 and 2022. Trillion with a T. This massive influx of capital actively inflated housing prices, which fundamentally transitioned homes from being, functional shelter for families into highly leveraged speculative assets. So you're literally fighting against corporate wage priorities and central bank asset inflation at the exact same time. And this creates what economists call a K-shaped economy. Think of the letter K. The top arm points up, representing institutions that are continuously extracting wealth through 2 to 3% interchange fees per transaction and keeping people in perpetual debt cycles. Meanwhile, the bottom arm points down, representing the average person, where everyday spending slows and delinquencies, especially in things like auto loans, begin to rapidly rise. The two experiences of the economy are completely diverging. Let's move on and look at the reality on the ground, because it's absolutely crucial to prove this isn't just some abstract economic theory or an exclusive problem for coastal elites. Take San Antonio, Texas, for example. This is a historically affordable Sunbelt city. Now, a $100,000 salary covers the basics quite well for a single person there. But because of surging housing and skyrocketing insurance costs, a family of four now needs a massive $199,181 in combined income just to live comfortably. That perfectly exemplifies how even historically affordable cities are becoming total debt traps for middle-income earners trying to raise a family.
Now contrast that southern example with Vermont up in the Northeast. Here, baseline costs are 13 to 14% above the national average. So a $100,000 salary barely covers the absolute necessities: rent, heat, and groceries. And the result? Middle-class residents are being forced to either dramatically draw down their hard-earned savings or just pack up and relocate entirely. And when those savings dry up, reliance on credit steps right in, which, as you could probably guess, perfectly loops back to those high-interest banking mechanics we diagnosed a few minutes ago.
Which brings us to the middle-class trap. When you combine all these hidden mechanics, the housing squeeze, the bank spreads, the localized inflation, they form a system that's essentially designed to look like progression while actually inducing total stagnation. The engine of this trap thrives on a little thing called bracket creep. It acts exactly like a financial treadmill. Your nominal wage goes up, you get that raise at work, the numbers on your paycheck literally look higher. But that raise pushes you into a higher tax bracket while inflation just completely eats the rest. Ultimately, you are taxed more, but you possess absolutely zero increase in real purchasing power. You are running faster and faster just to stay in the exact same place.
So let's trace exactly how this operates in three final steps. Step 1. Quantitative easing. When central banks pump money into the economy, fuels massive housing bubbles, inflating the price of entry. Step 2, whatever wealth you do actually manage to accumulate becomes entirely locked up in illiquid assets, like the equity in your vastly overpriced home. And step 3, because your wealth is illiquid, your everyday accessible liquidity is drained just to service perpetual debt on credit cards and auto loans rather than being used to actually build up your personal wealth portfolio.
This brings us to the absolutely crucial takeaway from all our source data today. The evaporation of the six-figure salary, it isn't a mistake. It isn't a glitch in the matrix or some temporary accident. It is the exact, finely tuned mechanism that fuels corporate balance sheets. Your liquidity, the cash you earn from your hard labor, is being systematically redirected away from building your personal equity over to servicing institutional debt.
So I want to leave you with this thought to help analyze your own financial footprint. Take a real look at your monthly cash flow. Look at where your income actually goes after taxes, housing, and the essentials. And ask yourself honestly, are you actually building your own equity, or are you trapped servicing corporate debt? It's definitely a tough question, but understanding these underlying mechanics is the very first step to changing your position on the board. Thanks so much for joining me on this explainer.